Good morning. Ready to start You need to get ready right now. The next 45 days are a critical time to position yourself correctly for what could be an extreme 2026. Forget what everyone else is doing. You need to focus on the top 5 stocks to buy nonstop over this exact period. These aren't just any stocks. These are stocks that are now great deals specifically because of the recent dip. You're looking for proof? These stocks have huge, real proof of concept. And these are the stocks that you can feel good about buying slowly over time, building a position. The case for each of these, including the catalysts, the risks, and the strategies, is about to be presented. You can be the judge. Just remember, the timestamps are down below, and if you're the one taking the ultimate risk, you absolutely must be the one doing the ultimate frisk. You must always do your own due diligence on every idea presented. Okay, let's begin. So, what's happening in your portfolio right now? We are coming off the worst week since April. That infamous fear gauge, you saw it. It went from extreme greed to extreme fear almost overnight. Most of your tech names hit all-time highs on October 28th, and they have gone straight down since then. Look at the damage. SPY, which tracks the S&P 500, is down 2.34%. The QQQ, is down 4.09%. That's the NASDAQ 100, a very, very tech-heavy index. NVIDIA is down 7.27%. It just hit $5 trillion in market cap on October 28th, and since then it dumped about 7.27%. AMD is down 11.65%. Palantir, down 15.1%. SoFi, which is supposed to be SoFly, is down 14.21%. Microsoft is down 8.35%. Meta is down 17.4%. And Tesla is down 8.29%. Sound AI is down 33.93%, Hood is down 14.5%, and a great data center play is down 18.23%. APLD, another great data center play, is down 17.96%. Now, here is the truly crazy part. Many of these exact stocks fell this much after reporting blowout earnings. Take Palantir, for example. Many are arguing this was the best earnings report for any software company ever, and it was well above expectations. Yet the stock? Boo. These are incredibly brutal sell-offs over a very short time frame, aren't they? But you have to understand this is nothing new. These are all breathing cycles that are important to happen and are actually very, very good for the overall trend. A good, lucrative bull market is one that has these regular breathing cycles, regular dips, and regular periods of time where you push out the weak hands that have no conviction in the stocks they hold. So, what are the walls of worry that you're dealing with right now? For starters, the government shutdown. This means flight delays, food stamp freezes, regulatory paralysis, and government instability. This is all very, very bad for market sentiment. Then you have the data fog. Critical economic data is just simply not being released anymore, leaving you in the markets flying blind. If you're thinking about the CPI, the jobs report, or retail sales reports, all of this is being delayed because of the government shutdown. And it was already kind of foggy because of how the Trump administration has been reporting these things. And then you have tariff uncertainty. The U.S. Supreme Court has been ping-ponging over U.S.-China tariff rules. On top of that, you have short sellers that are targeting top-tier AI names, and even names with rock-solid fundamentals are getting piled on by short sellers who are then going on media and fear-mongering everywhere. And then you have the big one, valuation concerns. Besides this recent big dump, there was really no real consolidation since April, which means that prices stretched month after month after month. And when you have prices just going straight up, well, people start sounding the alarms on valuation concerns. Now, when you're looking at all these different factors, a few of these are going to be very, very short-term. Polymarket shows that the odds of the government shutdown ending within the next few weeks are increasingly high. Who knows how long this is going to stretch out, but this isn't going to be a permanent headwind. But of all of these, I would say the stickiest worry, the one that matters most to you, is the valuation concern. Yes, some 85% of S&P 500 companies have reported beating on their earnings. But the thing is, there's a lot of skeptical capital on the sidelines here, and they don't want to buy in unless there's a big dip. A huge chunk of folks have been sitting on the sidelines since April, and they've said, wait, we're waiting for a much bigger crash, we're not going to get in. And the stocks have gone straight up since then, and they've only become more and more affirmed with their conviction that they need to wait for a dip. These folks are not going to be diving in unless they see a major crash or at least a sizable market dip that gets bought up. There's this famous meme where stocks are going straight up for like 6 months and then they dip 5%, and suddenly everyone's like, bro, what's happening? Why is the market dropping so much? Well, you have to remember, folks, that this is a very important part of the process. You need breathing in order to have a sustainable bull market. Something that gaps straight up is going to end up gapping straight down. But something that goes up in a stair-step pattern, that's a lot more sustainable. And the more stair steps, the more dips that get bought up, the more conviction is built throughout the market, which inevitably, actually over the long run, creates massive bubbles. But when you're in a cycle where everybody's questioning everything, that means that you're still climbing that wall of worry, right? The more people fearmonger about bubbles, valuations, and prices going up too fast, the more opportunities you have for these catalysts to cause massive dumps in price where people that have no understanding of the things they're holding go run for the hills. And you have these price checks. And then once dips get bought up, well, assets that actually are worth buying get reaffirmed. Now, this is definitely true in individual bull markets, but it's also true if you look at the 100-year history of the market. The reason that markets do inevitably find buyers at even the biggest crashes is because people do have faith in the long-term picture, because they understand how the financial system works, and they understand that at the end of the day, companies innovate, government prints more and more money, and the Fed stimulates, and people with assets long-term win. So can anyone say if this pullback or a different pullback that you're going to be experiencing is going to be the big one? No, of course not. But here's what I can tell you. Any pullback is a massive opportunity. And when you're looking back at this time in 6 months, in 12 months, in a couple of years, you're going to wish that you made the right moves. Why? Well, because there's a ton of reasons to be optimistic for 2026. It's setting up to be the most extreme market we've seen ever. What are these reasons to be optimistic for 2026? First, AI CapEx commitments. Hyperscalers and governments have committed $1 trillion plus in spend. Some numbers are many multitudes of this, and numbers dating out to 2030 are many, many multitudes of this. You also have more rate cuts incoming. The easing cycle is going to continue through early 2026 and beyond. And then President Trump gets to pick his new Fed leader in May. And this is going to be a major shift from Powell's slowly easing tone to Trump's wanting to stimulate tone. And he's going to pick somebody that is going to stimulate the market like crazy. And then you've got the midterm cycle liquidity boost. Election year dynamics tend to favor credit easing. I think Trump is going to be even more aggressive with this because that's kind of how he plays everything. And he's been very, very vocal that he wants a Fed appointee that is going to cut rates substantially. And if there's any kind of weakness in the market, you better bet he's going to go even crazier on that. Now, historically, if you look at any period of time where the Fed has cut rates, multiples expand. Multiples tend to expand very, very aggressively as rates get cut and liquidity expands. People are simply willing to pay way more for the same earnings, revenue. So even if revenue doesn't go up, which of course it will go up because rates are going to be cut and more money is going to be flowing everywhere, but even if revenue doesn't go up overall, just the fact that rates are getting cut means that you're going to see a big multiple expansion, in my view. Now, President Trump wants to send $2,000 tariff checks out to the people, which are basically stimulus checks, he said this morning. This will cause even more melting up. And whether or not he actually does this, it's pretty clear that the president is more than willing to do any kind of stimulus to throw money around to make sure that the economy is looking good before midterms. And then you've got $6 trillion plus of sideline cash sitting in T-bills, T-notes, T-bonds at the Treasury, waiting to buy up any dip worth buying. Not all of this is going to go into the market, but as you lower rates more and more and as liquidity expands, well, a lot of people are going to realize, okay, my dollars are going to be eroded faster than the interest that I get on them, so I need to put them somewhere. Now, do I think it makes a lot of sense to dramatically cut rates, really, really loosen liquidity, throw tons and tons of money around at the same time where we have assets at all-time highs? Probably not. It would be much better to just stimulate slowly. If you look at the last few decades of doing this, what happens? You get even crazier asset bubbles each time you do this type of policy, and you tend to destroy the USD further, making people that own shares in companies richer and richer and the average person poorer and poorer. I personally don't think that's a good thing for a country. However, as an individual, if you're looking to protect yourself and position correctly, well, you got to look at these trends and you have to understand that positioning yourself into the right assets is going to be the way to go. Now, along those lines, what are the top 5 stocks that I see value in right now at current pricing that I believe are going to be good assets for this coming condition? None of these stocks are fugazi stocks that are bubble bust types of stocks. These are stocks that have real massive revenue growth, real massive margin growth, real massive scalability, real competitive advantages, and are real deals down from all-time highs. Okay, number 5, Duolingo, ticker DOL. Duolingo is the biggest and most popular language learning app in the world. Stats show Duolingo commands around 60% of all language learning app usage in its category, and the online language learning market is expected to continue to grow pretty damn fast. And when it comes to future AI implementation, Duolingo has a huge user base, generating large amounts of data on how people learn and how people learn languages. And that supports better personalization, adaptive learning algorithms, and content optimization, which can really set them apart long term. In any field, those who have the most data are going to be the ones that have the best AI, because AI uses all of that data to train. Now, Duolingo just did something very interesting, which has actually completely destroyed their stock, but I believe is going to set it up for massive growth long term. They essentially just reported a great quarter this week and explained that they decided to aggressively put user growth above short-term monetization. They're focusing on the user, the customer. Now, a lot of people say, why would you focus on the user? Money, always first. Well, if you invest your efforts and money into focusing on the customer long-term, they're going to be way happier and they're going to make you way more money. Wall Street and hedge funds want these companies to be gutting themselves in order to completely get as much short-term cash as possible. Now, however, that doesn't make sense over the long term, and that's a very flawed strategy, and it's creating a massive value arbitrage here. Wall Street has decided to punish it with a 67% dump from just this past summer's high. Now, here's the thing about Duolingo. Despite bears claiming the stock should go bankrupt, it's a free cash flow machine. Every quarter since Q1 of 2022, it's printed more and more free cash flow while growing its user base substantially. If you look at Q3 numbers, in compared to Q3 of 2024, it's insane how much they've improved just year over year. Daily active users is up 36%. Monthly active users is up 20%. Paid subscribers is up 34%. Paid subscribers penetration is up to 9%. Essentially, the amount of long-term monthly active users they convert to paid subscribers, that's up to 9%. But remember, this company makes money through ads and paid subs, so they get paid either way. Revenue is up 41% year over year. Total bookings is up 33%. Net income is up more than 10x, and adjusted EBITDA is up from $47.5 million to $80 million. So despite all these record numbers, the stock has absolutely been destroyed. Bears are expecting this stock to go to zero. I think this is ridiculous, and I think there's a big arbitrage opportunity here. Number one, Duolingo Max expansion, which is their AI-powered tier. Duolingo's premium Max tier uses GPT-4 to simulate human-like tutors through features such as Explain My Answer and Roleplay. And as AI models get cheaper and more capable, Duolingo can scale personalized tutoring globally, creating a true AI teacher at scale. I think it's a ways out to do this, but I think this is a big catalyst for them. Wider rollouts mean higher conversion rates from free membership tiers. That means more paid users, right? Number two, hyper-powered learning loops. With billions of lessons completed, Duolingo's beta set trains its own adaptive AI models that tailor difficulty, pacing, and vocabulary to each learner. The results? Faster progress, higher retention, better lifetime value. I'm betting that AI-driven engagement is going to actually boost daily active users and margins long-term a lot. And then, of course, you have AI-generated content. AI can now auto-generate new exercises, sentences, and storylines, cutting content creation costs and increasing language coverage substantially. This is going to reduce dependency on human linguists, expand languages faster, and improve scalability. This means margin expansion and rapid course development. Now, the big thing here, and I can't stress this enough, is the ability for Duolingo to use AI to create a cross-skill platform expansion into math, music, and more. Duolingo's AI infrastructure, it's not limited to language. It's a universal learning engine, and it can use all of the data that it's used from language to apply learning methods to many other subjects. New apps like Duolingo Math and Duolingo Music are leveraging the same AI framework, expanding total addressable market quite substantially. And diversification beyond languages is going to multiply new verticals of monetization and dramatically increase the total TAM, total addressable market. So anyways, I think there's a lot of opportunity here, and this is what we told Discord members. DOL is the most oversold we've seen all year on the Relative Strength Index. Meanwhile, the company just reported a blowout earnings and an aggressive change of strategy to prioritize long-term user generation over short-term monetization. Okay, number 4 is Supermicro SMCI. So Supermicro builds the powerful servers and hardware that run AI and cloud systems. Its specialty is making energy-efficient, customizable machines that companies companies like NVIDIA and AMD use to quickly build out new data centers. So what makes them different from the competition? Well, instead of just using fans and air, SMCI actually designed systems where liquid flows through special pipes or plates to pull heat away from powerful chips like NVIDIA's H100s. This helps data centers run faster, use less energy, and fit more AI computing power into the same space, making liquid cooling one of SMCI's key growth areas and what it's really known for. Now, how big exactly is the data center liquid cooling market? Well, research shows that the industry for this is expected to grow very substantially into 2030 at a 21.6 CAGR. And this company is a juggernaut in the space. It's a leader, yet the stock is on a big, massive dip right now after an earnings that wasn't bad at all, was actually showing progress in their promises. If you look at the headlines, earnings surpassed expectations, but they say revenue declined slightly. And so what are bears doing and short sellers? They're rushing to scare people out of the stock. The problem? Well, this fear is very, very unjustified because all of this has been expected. For starters, the revenue was delayed. It wasn't lost. SMCI's reported revenue drop wasn't because of weak demand. It was because of customer-requested configuration changes on new AI server orders. That means those sales simply shifted onward. They weren't canceled, and the order book remains very, very strong. So next quarter's revenue should balance, and I think you're going to see Q1 and Q2 specifically for SMCI that look very, very strong. Number 2, huge backlog overall shows undeniable strong demand. Despite the short-term dip, SMCI's backlog jumped to $13 billion, driven largely by new NVIDIA AI chip orders. That's a massive pipeline of business that will flow into upcoming quarters in my view. They also raised full-year guidance. Instead of cutting expectations, SMCI actually raised its full-year revenue outlook to $36 billion, up $3 billion from before. That shows confidence that demand for AI hardware that they sell and the components that they sell remains very, very explosive. Then number 4, margins dip for the right reasons. Bears say margins are going to cause the stock to go bankrupt. But margins came down just a bit, and that's actually because SMCI is selling more complex liquid-cooled rack-scale systems, products that take more work, but actually deepen customer lock-in and position SMCI at the high end of the AI data center market. And long-term, I think that margins are going to expand again. And then the valuation has already priced in substantial bad news. Even before the dip, SMCI was underperforming. Now it's almost ridiculously discounted. And even when you're comparing it to its own historical average, I mean, it has substantial upside. But when you compare it to NVIDIA, AMD, is this trading at a discount, especially considering that it is right in the middle of the capital flows of all this money going into data centers. And this is what we sent out to Discord members. SMCI is looking like a great deal after an overreaction breakdown on earnings. We believe SMCI will bottom soon, and in cases A and B will inevitably push higher through Q1 to 2026. We believe the sell-off was an overreaction, that AI server demand is exploding, and we think the setup is attractive now. Okay, moving on. Hims & Hers, ticker symbol HIMS. Hims & Hers is a telehealth company that sells prescription and over-the-counter treatments for things like hair loss, hanky-panky dysfunction, mental health, and skincare, all online. It connects people with licensed providers and delivers treatments directly to their door in discreet packaging. Very, very important, especially if you're buying hanky-panky stuff. In short, Hims makes getting everyday healthcare and wellness treatment simple, affordable, and private through an app and website. Now, look, we've been fans of this one since last fall when it was trading at lower prices, and then it ran all the way up to $70+, and now it's all the way back down here, which I believe is a great deal when you consider that the telehealth market size is expected to balloon, and Hims is a juggernaut in this space, and showing no signs of stopping. I believe that Hims at its current price is an absolute steal for the patient. Why? What is the evidence based on the business itself? Well, for starters, recent earnings, massive revenue growth, and subscriber momentum. The company is massively growing its revenue, it's massively growing its subscribers, it has clear long-term targets and strategic ambitions, it has profitability coming into view, and when you're looking at upcoming catalysts, I mean, you have Canada plus Europe launches, you have the GLP-1 expansion plus branded drug rollout, you have new partnerships in weight loss and hormone health raising ARPU and subscriber retention data, you have potential guidance raise if international growth hits like we think it will, and they're currently in discussions with Novo Nordisk, and that can be a big potential catalyst as well if that goes through. Now, what about the stock projection? Well, this is what we send out to Discord members. Hims is very oversold, and at the same time as their core treasury asset, Ethereum, is oversold and starting to bounce. I believe the upside to $72.41 resistance in early 2026 is likely and something to pay close attention to, and I think it can build well over those levels. Number 1, PLTR, Palantir. So, Palantir is the most impressive software company in the world.
Imagine if you had a software that you downloaded that learns from your data over time and can make you 3 times more efficient, 5 times better at saving money, 10 times more effective at anything you do, and make you a superhero. Well, that's more or less what Palantir's platform does for institutions and individual companies around the globe, and of course for government agencies too. Now, I know I say this until I'm blue in the face, but Palantir has been for many, many years one of our favorite stocks, even as low as the $7 region. And it's not that we just randomly decided to like the stock. It's that we built conviction based on the results of this actual business, the results the actual business was giving us over time. Now, in the Discord, before big earnings reports, we publish these prep reports where we talk about what to look out for. I think that's very, very important to understand not just that an earnings report is coming, but what to actually analyze on the earnings. And with Palantir, the main points were their AIP platform demand, the government contracts, profit margins, forward guidance, backlog, and retention, and some very, very key questions on the specifics. In this latest earnings report, let me just say, knocked everything that we were looking for out of the park. It was better than my expectations, and I'm a pretty big perma-Palantir bull. But the stock still got beat down. Why? Well, just general profit taking after massive runs is normal. But there's also this dynamic with short sellers. The famed Michael Burry, who people like to say predicted 25 of the last 3 recessions, is short Palantir and NVIDIA. And of course, the media made the huge deal about this, making sure that everybody knew. To be more accurate, he bought put options on it, right? And so immediately once he disclosed that his put options were basically massively profitable, which is a great business model, all you got to do is go short something, buy some put options on something, and then say it's a terrible deal, it's going down, the big bubble is here. And then all of a sudden, you're immediately right. That said, of course, I believe this is all short-term noise. And when it comes to the bigger picture, Palantir is well on track to be one of the most insane companies of all time.
Palantir is the only AI company that dominates both high-security government contracts and private sector adoption. That's an extremely hard balance to pull off. Nobody can do it, but Palantir's platforms are already doing it. They're built for the AI age. Unlike older SaaS platforms, Palantir's whole business model is structured around data integration, modeling, and now agent-based AI. Exactly what companies and agencies are trying to build today. It's basically skating to where the puck is going, while everybody else is kind of like falling off their skates and they've been face-planted into the ice. They've got a massive global TAM. We love Tammy McTammy. Whether it's NATO defense contracts, public health data in Europe, or private corporations in Japan and the US, Palantir has tentacles globally. And that TAM is expanding as AI spending surges. It's also a free cash flow machine. For a lot of the doom and gloomers in terms of, oh, this company doesn't have enough cash flow, well, Palantir generated $141 million in free cash flow this past quarter. And if you understand software, you understand that if Palantir wants to, they can decide to completely gut their R&D, they can decide to completely gut their onboarding expenses and start shooting out free cash flow like crazy. But they don't. And that's why people love them, because all this money can go back into reinvesting into making their platforms better, into giving them ability to expand substantially more, buy back shares, weather macro noise while other tech firms are scrambling for profitability. Now, this is also one of the few AI plays out there, I hate to say it, that's actually delivering today. There's a lot of companies that are very promising, but they're not delivering today anything crazy. Palantir is not one of those companies. A lot of companies talk about AI. Palantir is already selling and deploying it, and that is just a fact. Now, if you're in the Discord, you know that we have this tier list, which has become very, very popular, where you have S tier, A tier, B tier, C tier stocks, and so on and so forth. And we only have one stock in S tier status, and that is Palantir. Why? Well, because it's one of the most obvious multi-trillion-dollar opportunities that is still trading at under $500 billion in market cap. Now, again, I get it. It's not as good of a deal as when it was at $7, but long-term, if you're looking at the bigger picture here, I think a lot of people are going to wish that they bought it at under 200. I think people are going to wish that they bought it at under 300, and so on and so forth. If you look at the long-term price range, I've made the argument time and time again, and I'm looking at $68 a share, a $1.38 trillion market cap by 2030. So the current dip I see as a great opportunity. I think that this is a play that you do have to be patient overall, because a lot of the valuation this company is going to grow into in terms of earnings and based on multiple expansion or contraction. Sure, you could see some pretty big dips, but I see all of this as an opportunity on a massive journey for Palantir shares, a massive journey to realizing a lot more upside. And that's my view there. Anyways, folks, that caps off today's video. Make sure to let us know your favorite stocks down below. Make sure to join us in the Discord with that first link down below. And of course, make sure to hit that subscribe button and like the video because it helps push this video out to way more folks and it helps us out tremendously. Anyways, that caps off today's video. Have a great rest of your day.